All right, let's talk about a name you've almost certainly seen before, McKesson. You see it on trucks, you see it at the pharmacy, but what most people don't see is the massive shift happening inside this company right now. And if you're an investor, well, that's where the real story begins.
First things first, let's get a handle on just how big we're talking. $359 billion. That's not a typo, that's their revenue for the last fiscal year alone. So we're not just talking about a healthcare giant. This is one of the biggest companies on the planet, full stop.
So that begs the real question, right? If you're a potential investor, you've got to ask, how does a company this huge get any bigger? Where's the growth? Where's the upside from here? What's the story that makes this stock a compelling investment today?
Okay, so to understand where McKesson is trying to go, you first have to really get a grip on what it is right now. We have to look at the foundation of this whole operation, this stable, predictable behemoth that underpins everything else. The whole business of getting drugs from manufacturers to pharmacies in the US is a classic oligopoly. Now, that's just a fancy economics term for a market that's basically run by a tiny handful of companies. We're talking the big three: McKesson, Cencora, and Cardinal Health. Between them, they control something like 95% of the entire market. It's their world, everyone else is just living in it.
And good luck trying to start a competitor. I mean, the barriers to entry are just massive. Think about what you'd need: a nationwide network of specialized warehouses, a supercomputer-level logistics system, decades-old relationships with every hospital and pharmacy. Oh, and you'd have to navigate a regulatory maze from the DEA that would make your head spin. It's a fortress, a really, really powerful competitive note.
So their core business is actually kind of like your local power company. It's a utility. They move an insane amount of product, but they only make a tiny, tiny profit on each individual item. The magic here isn't big margins. It's being incredibly, almost unbelievably efficient. It's that operational precision that turns all that volume into a predictable, nonstop river of cash, year in and year out.
Okay, but here's where the story gets really interesting. Because McKesson is not just sitting back and counting its cash from that utility business. Nope. They are in the middle of a massive, high-stakes pivot. They are actively trying to change the entire narrative around the company for investors.
So what are they actually doing? They're reorganizing the whole company. They're going from 4 broad, kind of clunky segments down to 3 super focused ones. They're rolling their core drug business together, keeping their tech segment, and this is the big move. They're pulling out their fastest growing, most valuable businesses, like oncology services, into their own shiny new segment. At the same time, they're looking to get rid of their slower medical surgical business. It's all about focus.
And why go through all this trouble? Well, they're basically sending up a giant flare for Wall Street. They are tired of being valued like a boring, low-margin distributor. They want investors to see the high-growth, high-tech parts of the business and say, whoa, that part deserves a much higher price tag.
So the playbook is actually pretty straightforward. Step 1, take all that cash from the boring, stable business. Step 2, plow it into the exciting, higher-margin businesses. Step 3, cut loose the slower parts to make the story cleaner for Wall Street. And finally, Step 4, sit back and hope the market sees what you're doing and re-rates your stock higher. It's a classic value unlock play.
Look, a strategy on a PowerPoint slide is one thing. But as an investor, you need to see the proof, right? You need to look under the hood at the actual engines that are supposed to drive all this new growth.
And boom, here it is. If you only look at one thing in this whole explainer, look at this. These are the company's own projections. They're telling you the core business will chug along at a solid 5 to 8% growth. But then look at the new focus areas, RxTS and especially oncology. We're talking double-digit growth, more than twice as fast. This is the whole thesis in one chart.
So let's talk about growth engine number 1, oncology and multispecialty. And this is so much more than just being a delivery truck for cancer meds. Through its U.S. oncology network, McKesson is deeply embedded with cancer clinics, providing software, practice management, the whole shebang. By getting that deep into the provider's business, they capture way more of the profit than a simple distributor ever could.
And engine number 2 is their tech business, RxTS. This is the smart stuff. It's a high-margin platform that helps connect everyone, drug companies, patients, pharmacies, to make drugs more affordable. And it works. Last year alone, this segment helped patients save more than $10 billion on their meds. It's one of those rare win-win situations in healthcare.
Okay, so it all sounds pretty great, right? A cash cow core business funding new high-growth ventures. But now it's time for a reality check.
Because no investment story is complete without looking at the risks. And for McKesson, there's some pretty big ones to navigate.
And these aren't just small bumps in the road. You've got constant pressure on generic drug prices, which just eats away at margins. Then, as they get bigger in areas like owning parts of clinics, the government starts looking closer for antitrust issues. There's always the risk of some new law out of D.C. that could change the whole game for drug pricing. And maybe the biggest one, just execution risk. Trying to turn a ship this big is incredibly hard to do.
And yeah, we have to talk about the elephant in the room, the opioid crisis. McKesson's bill for its part in that is a staggering $7.9 billion. Now, the good news for investors is that it's a known number, and they're paying it out over 18 years, so it's manageable. But the bad news is the whole ordeal forced them to add a lot of permanent compliance and operational costs. That's just part of the business now.
And then you've just got the general headaches of the modern economy. Things like drug shortages messing with the supply chain, inflation driving up wages, and higher interest rates making it more expensive to carry all that inventory on their books. It all adds up.
All right, so we've seen this stable foundation, the exciting growth pivot, and the very real risks. Let's put it all together and get to the bottom line for an investor. What does the valuation look like, and what are they doing with all their money?
When you stack McKesson up against its main competitors, you see something interesting. The market is already paying more for it. Whether you look at price to earnings or price to sales, it's trading at a premium. What that tells you is that Wall Street is already buying into this transformation story. The pivot isn't a secret, which means a lot of the potential good news might already be baked into the stock price.
But let's go back to the engine that drives everything we've been talking about, the cash. Last year, McKesson spit out $5.2 billion in free cash flow. That's the pure cash left over after running the business. It's the fuel for this entire strategy.
So what does that huge number actually mean for you, the investor? Well, if you translate it into a yield based on the company's market value, it comes out to about 6%. You can think of that as the company's cash earnings relative to its stock price. And the 6% yield, that's a really solid, tangible return.
So where does all that cash go? Well, about a third gets put back into the business for M&A and reinvestment, and a small sliver goes to dividends. But check out the biggest piece of the pie. Nearly 60% is used to buy back their own stock. Last fiscal year, that was over $3 billion. That's a huge vote of confidence from management, and it directly makes each remaining share more valuable.
So, this is the puzzle for any potential investor. On one hand, you have a brilliant plan. Use a stable cash machine to build a faster-growing, more valuable company. On the other hand, the stock price already reflects a lot of that optimism. So the question you really have to ask is this a smart pivot you want to be a part of? Or is it a high-priced bet that depends on everything going perfectly right? That's the call you have to make.